Hello and welcome to Improving Your Credit Score module. We at Debt Free Living believe your credit is the heartbeat of your financial life and future. Life is easier with good credit, but very hard and expensive with bad credit. We believe that your credit can be fixed if it is already challenged. But a word of caution, there is no quick fix. Anyone who promises a quick fix for your challenged credit isn't telling the truth and will fail to deliver on their promise. Credit can be fixed, but it takes time, knowledge of how credit scoring works, and a change in behavior with money and credit management. Let us run through the objectives of this module. I would like to begin by defining a credit score. We will also discuss the root cause of why people end up having bad credit and the cost of a bad credit. We will review the anatomy of a credit score and discuss at a high level the reasons why people have bad credit. Next, I will discuss a few strategies to improve bad credit and why you should care about fixing your credit. What is a credit score? A credit score is a three-digit number, for example, 734, assigned by the credit bureau. The credit score is the DNA of your financial life. In Canada, the credit score is called the Beacon score and ranges from 330 to 850. The Beacon score is used by lenders to determine their risks and to assess the borrower's credit worthiness. Lenders rely on Beacon score to approve or decline a loan application and to price a loan by setting the interest rate that they may charge. A 330 credit score is the lowest, and 850 is the highest. 650 is the mean or average score. Credit scores above 650 are considered good to excellent. Credit scores ranging from 649 to 330 are considered fair to bad. As I've mentioned, the score is calculated by the credit bureau based on your payment history. There are two credit bureaus in Canada, Equifax and TransUnion. Banks, credit card companies, and retailers report borrowers' debt payment history and collections. Often the report goes to both credit bureaus. The bureaus also record items in the public record such as judgment, garnishes, bankruptcy, and discharge. Let us run through a few root causes of people ending up with bad credit. Determining a credit score is a complex formula, but there are well-defined rules. These rules are unknown to most ordinary people, and there are some people who know the rules but end up ignoring them due to difficult financial times. The predominant rules are: do not spend more than 50% of the allowed limit. Pay your bills on time, also known as never miss a payment. And refrain from obtaining more credit than you absolutely need. We live in a consumer society that puts pressure on us to compete with family members and friends. This can result in an overextension of credit. It's basic human nature to feel, I must have it now. We often purchase things we cannot afford. We buy things under the excuse that, hey, I can afford the minimum payment, no problem. Other people may have unstable, low-paying jobs or find themselves faced with a layoff and be unable to find suitable full-time employment. All these situations will contribute to having bad credit. Getting out of this situation becomes a mission. Having bad or challenged credit will make everything you buy more expensive and sometimes extremely difficult to obtain. Wherever an individual with challenged credit seeks financing for a mortgage, home equity line of credit, car loan, credit cards, house insurance, that individual is viewed as a high risk and many times he or she is declined for new credit. Not every lender will consider extending credit to challenged credit individuals, but those who do will charge higher interest for the privilege of extending them credit. Higher rates translates into higher monthly payments. Conversely, the better your credit score, the lower your rate, and therefore, the lower your monthly payment. What distinguishes good credit from bad credit? The payment history factor represents 35% of your credit score. Your payment history tells lenders how you have been paying your bills, one or more late payments, any collections, any past due accounts, and public records such as bankruptcies can seriously cripple your credit score. To illustrate the impact of payment history on your credit score, let's say you fail to pay one single bill for more than 30 days. The one 30-day late can lower your credit score by 50 to 75 points. Late payments are a killer to your credit score. The good news is that your current history matters more than the past. The newer the late payment, the more damaging to your credit score. Late payments that happened 2 years ago have less impact than a late payment that happened a month ago. Late payments tell the lender that you will not pay your bills on time. Thus, the lender may decline your application for new credit or charge you a higher interest rate. The amount owed factor represents 30% of your credit. This factor takes into account how much you owe on all your accounts, how many accounts you have that carry a balance, and what percentage of your available credit are you using. In other words, let's say that you have 2 credit cards, one Visa and one MasterCard, and a line of credit. The limit on your Visa is $10,000 and your outstanding balance is $9,800. You are using 98% of your available balance. Similarly, you are carrying a similar balance and high percentage of your available credit on your MasterCard and line of credit. Using high percentage of your available credit tells the lender that you are tight on money and using credit to support your lifestyle. Combine a high amount owing and late payment history and you end up with a challenged or less than perfect credit score. Your payment history and the amount owing combined represent 65% of your credit score. To maintain a good or better than average credit score, you must keep credit card balances under 50% of the available limits at all times. The new credit factor represents 10% of your credit score. This factor focuses on the changes in your credit pattern. It includes the number of recently opened accounts, the number of credit inquiries, and the time since each account was opened and how often you apply for credit. Too many new credit inquiries tells the lender that you are looking for credit and may have more credit approvals than is shown. Lenders like to lend to stable credit-worthy clients who represent a good risk. It is important to refrain from taking additional credit that is not needed. In fact, you should decline offers for new credit unless you intend to use it. The length of credit history factor represents 15% of your credit score. This factor looks at how long you have had credit, the time since you opened an account, and the time since the last account activity. The older your account, the stronger is your history, especially with a good payment record. Many people have lots of open accounts but with no recent account activities. Closing an older account could hurt your credit score. Closing older accounts makes your credit history younger, thus reducing your score. The type of credit used factor represents 10% of your credit score. This factor looks at the type of credit mix you carry in your wallet. A mix of credit instruments is the best way to develop a good score and keep it. The most important consideration is to be picky about the type of credit you apply for because that will really help your score. The scoring system favors brand name credit cards like Visa, American Express, and MasterCard. The scoring system does not favor third-party finance credit cards such as department store credit cards from Sears, Canadian Tire, Home Depot, or The Brick. This type of credit is considered to be particularly low-quality credit as the holder of such cards can appear desperate for credit. Want to improve your credit score? In the next 2 slides, we will discuss 18 reasons why your credit score is not as high as it could be. The following are 18 reasons why people's credit score is not as high as it could be. 1. Amount owed on account is too high. 2. Delinquency on accounts. 3. Too few bank revolving accounts. 4. Account payment history too new to rate. 5. Too many recent inquiries in the last 12 months. 6. Too many accounts opened in the last 12 months. 7. Proportion of balances to credit limits is too high on revolving accounts. 8. Amount owed on revolving accounts is too high. 9. Length of revolving credit history is too short. 10. Time since delinquency is too recent or unknown. 11. Number of accounts with delinquencies. 12. Too many derogatory public record or collection. 13. Amount past due on accounts. 14. Serious delinquency, derogatory public record or collection. 15. Lack of recent installment loan information. 16. The date of the last inquiry is too recent. 17. Number of bank revolving or other revolving accounts. 18. Too few accounts with recent payment information. The following slides discuss some potential strategies to improve bad credit. To have a significant improvement in your credit score, you need to implement strategies and take actions on all the credit scoring factors simultaneously. Improving a bad credit is like going on diet. It takes time to see substantial results. Since payment history factor represents 35% of your credit score, one must do everything to improve on their payment history. The following are a few strategies you could implement to improve your credit history. Pay your bills on time, preferably in full if you have the capacity. If not, pay the minimum but on time. If you have missed payments, get current and stay current. Be aware that paying off an existing balance and closing the account will not help your credit score. Keep credit card and other revolving credit balances low. The ideal is to keep balances around 30% and not to exceed 50%. Don't close unsecured credit card accounts. Don't open new credit card accounts that you do not need in order to increase your available credit. Since the amount owed factor represents 30% of your credit score, one must do everything to keep the ratio of balance to credit limit in the range of 30 to 50% on revolving accounts. The following are a few strategies you could implement to improve your credit score. Bring your balance to below 50% of the credit limit if possible. When preparing to make a large purchase, bring those balances down to under 30% at least 3 months before applying for the loan. Balance the amount owed on various credit cards and line of credit. The length of credit history factor represents 15% of your credit score. The following are a few strategies you could implement to improve your credit score. Do not be in a hurry to open new accounts, because opening new accounts makes your credit history younger. Do not close existing accounts. Closing existing accounts also makes your history younger. If you must close existing accounts, close the most recent accounts. This strategy sometimes may work in your favor, since it actually will make your credit history older. The length of credit history factor represents 10% of your credit score. The following are a few strategies you could implement to improve your credit score. Confine rate shopping to a minimum when you are looking for a mortgage or a car loan from your credit report. Do not close an account in an attempt to eliminate it. If you have no credit or have challenged credit, it's okay to apply for a secure credit to reestablish your credit. Remember to check your own credit report and your own score once or twice a year. Doing it yourself, it does not affect your credit score. The type of credit used factor represents 10% of your credit score. The following are a few strategies you could implement to improve your credit score. Maintain a healthy credit mix of credit cards and installment loans. Do not apply for department store credit cards. This type of credit card makes you sound like you are desperate for any credit. Only apply for and open new credit accounts when needed. If you have credit cards, handle them responsibly. Do not close an account in an attempt to eliminate it from your credit report. Your credit score is one of the most important tools creditors use to determine whether or not you are a good candidate for a loan. Your credit score tells the lenders your payment history and the risk you represent to the lender. Bad credit prevents you from buying a house, getting a car loan, or applying for the convenience of credit. If you find a lender that is willing to lend you money, you will pay higher interest for the privilege of borrowing money. Life is cheaper with a good credit score, and it is easier to obtain credit when you need it. Why do we offer this information free of charge? At Debt Free Living, we believe in educating our client. We want to be your advisor to help you understand credit and how it works, repair your credit the right way, and gain a better credit through fixing your credit for good. If you are worried that you can't apply the principles contained in this insight, or if you have a question or comment, please call us or email us. We want to earn your business. We want to see you go from debt to wealth, to have a prosperous life. Thank you for taking the time to listen to the Improving Your Credit Score module. Should you have any questions, comments, or feedback, we would love to hear from you. If you like the solutions that we can deliver to you and your family, please give us a call for a free complimentary assessment of your unique situation. We hope that you have benefited from this presentation. If you did, we kindly ask you to pass it on to your friends and family. We look forward to hearing from you.